What's up YouTube? Dougie Chong here. Welcome to today's video where I'll be doing a quick update of my simulated portfolio. For those of you that don't know, I started a simulated portfolio a bit over a year. It's on Yahoo Finance, and I'll leave a link in the description below to a Discord chat where I post screenshots of all my trades. I don't know what's harder to believe, the fact that I've been making YouTube videos for a little more than a year now, or that the last portfolio update was back in May. So please leave a like and subscribe if you have not already. I promise 2021 is going to be an even better year. Alright, to start things off, let's take a look at the portfolio back in May. Keep in mind the portfolio started almost exactly 1 year ago with 100,000 US dollars. But back in May, the portfolio was hovering around 104,000 US dollars, which I thought was pretty good at the time considering the whole pandemic that happened. I saw the portfolio fall as low as about $82,000 at one point. I think that is one of the absolute hardest things to do as an investor, to ride out those low times. When you see a stock you believe in just sinking, getting hammered hard, and having the ability to just wait through it and not sell out is one of the hardest things to do as an investor. Of course, if the company really is headed to zero, if it's gonna go bankrupt, then there's no point holding onto that stock, but a lot of the stocks we see now are recovering. Today, my portfolio sits at a healthy $130,000. So whereas some other investors might have doubled or tripled their money when taking advantage of that low dip due to the pandemic, I'm quite happy with the gains that I have got. And a 30% increase for my first year of my simulated portfolio is much better than anticipated. A lot of very wealthy paid portfolio managers only meek out about 8% per year, and they are quite happy with that. So keep that in perspective when you look at a 30% return. That's why on this channel, I don't promise ridiculous returns. I don't say you can 10 times your money in a matter of weeks. I show you what you can realistically expect if you invest for yourself. So not too much has changed in terms of the makeup of my portfolio since May. I dropped my holdings of ExxonMobil stock. I took some pretty good gains from that stock and just exited it out completely. But most of my gains were simply got from holding on to the stocks that I had already bought. A lot I bought in March or April, or even before in like November and December of last year. But that just shows one of the myths of investing in the stock market. A lot of people think you have to be constantly monitoring it, kind of selling in and out when it goes low and high. I always check it every day, but really as an investor, you don't have to check it every day. You can buy a stock you really believe in and not even check it for years. Just hold it, sit on it, and then it'll appreciate over time. Alright, now let's look at the holdings in a little bit more detail. We'll start at the top with my most recent acquisition of Ryokan stock. I know I have a lot of stocks in my portfolio. I tried to keep it around 10. I think I have maybe 14 or 15 now. I'm gonna start consolidating them in the near term future. It's just really hard to keep track of too many stocks. Some people believe in the diversity, but really I think if you have more than 15 or so stocks, it gets hard to manage. So Ryokan stock is just one of 2 stocks in my portfolio that is actually down from when I bought it. I bought 100 shares at $18.34, and I think they are about $18.17 today, down about 1%. So really not down all that much. I like to buy stocks as they're going down and dollar cost average my way into the stock. But my luck hasn't been quite so good lately. As soon as I bought a stock, it seems to almost skyrocket or take up 5-10%. Hopefully I can get a little bit more Ryokan stock and build up a good position. Next up, we have Enbridge stock, which is up about 10% since I bought it not all that long ago. I expect this company to continue paying its dividend of almost 8%, so even if this stock does not appreciate too much, I'll be getting quite a lot from its dividend. However, at this price point of around $41, I will not be adding any more shares to my position, not unless it drops back down to around that $37 level. Third, we have Amazon, my absolute favorite stock of all time. I bought this stock at around $3,000 and will look to buy maybe 1 share or 2 shares more if it stays around this $3,000 for a little bit longer. At $3,000 per share, it is hard for investors with small accounts to get into this stock, but the potential for Amazon is truly great. They are dominating the e-commerce sector, and their command over web services through their Amazon Web Services, a lot of their cloud-based offerings, is simply phenomenal. Next up, we have Dropbox stock, which is up a moderate 2%. Dropbox is a cloud file storing solution, and they also own an e-signature company known as HelloSign. For these reasons, I believe the company can continue to grow, albeit with the risks of being completely eliminated by bigger competitors such as Google and Microsoft's OneDrive. I will probably add to this position if the price stays the same or drops a bit lower. Next up, we have Slack stock, and I bought this stock at $25.60, and it is up a whopping 58% in a matter of a few months. This shows the importance of diversifying your portfolio. I was kind of split 50-50 between investing in Dropbox or Slack, since they both aim to improve workplace productivity. If I had only invested in Dropbox, I would have completely missed out on these Slack capital gains, but since I invested in both, I got the best of both worlds. I have some Dropbox, and then I got a lot of the Slack gains. But of course, the race isn't over. I recently just bought both of these shares, so Dropbox stock could easily see a rally very similar to Slack. Of course, the recent rally of Slack price was due to the rumors and probably true news that Salesforce is going to acquire Slack. And with this huge run up of price, I will not be looking to increase my position in Slack. I will actually be looking to exit my position if the price goes up a little bit more. Next up, we have AMD stock, the company most known for graphics cards, but also more recently making CPUs. They sit at $87 today, up about 40% since I bought them back in June. This stock has been on an absolute tear, being a mere $4 stock a few years ago. The increase in price is justifiable since in recent years they have managed to create CPUs that are better than the huge juggernaut company known as Intel. That being said, I am not looking to increase my position of AMD anymore. I like how much I have, but I will add more shares if it goes back to around $80. Next up, we have Wynn Resorts, which is a hotel and casino company located in, I think they have a few locations in Las Vegas, Nevada, and even Macau. This is the second position in my account that is down. It's down about 8% since I bought the stock way back in December of last year. Basically, this stock, which lost almost all of its revenue due to the pandemic, is only a little bit lower than I bought it back in December. That is absolutely crazy. Of course, if I sold the stock near its absolute lows, I think it was around $62, I would have lost a lot of money. But since I was able to hold on, it's really not doing too bad at all today, and the future looks very bright. Next up, we have the benchmark ETF VOO. That's a Vanguard index fund which tries to track the S&P 500. For those of you that don't know, the S&P 500 is the top 500 companies by market capitalization in the USA. This stock is up a remarkable 17%, which doesn't usually happen in most years. This stock is basically in here to check the performance of my portfolio against the S&P 500. Next up, we have Triple M stock, which makes a lot of essential items from Scotch tape to N95 masks. Their stock is up 24% since I bought them in March, and their dividend is quite nice to collect as well. This company probably will not grow too much in the future, but it is a nice, stable stock to own. Next up, we have iRobot stock, which is up a whopping 72% since I bought them about, I think, in November of last year. Of course, iRobot is the company that makes those little robot vacuum cleaners known as Roombas. I sold about half the shares I bought at $70 But even then, it is I think higher now at around $77 or $78. I will not be adding any more shares to my position, but if the stock hits around that $100 mark, I will exit my position completely. The biggest lesson to learn from iRobot stock is to not sell out completely. I have almost never sold a stock completely and was 100% satisfied. It almost always seems to go up a little bit more or even a lot more, and you miss out on a lot of those gains. My biggest misses were on tech companies such as AMD and Shopify. I used to own them in the past and they kind of didn't really grow too much. They stayed rather flat or went up a little. I think I even sold some AMD shares at a loss, and they really didn't grow like crazy until this year. But if I had just held on to those stocks, I would have been reaping some pretty good capital gains. Next up, we have the FB stock. This social network company needs no introductions, and they will continue to generate ridiculous amounts of revenue from advertisements. I think my position in Facebook is fairly sizable. I think a little over 10K, and I'm up about $4.5 thousand on this stock alone. So I'll just continue to let that stock grow and continue to see the capital gains. Next up, we have Disney stock, which is comparable to Facebook, and I remember buying this stock back in April, seeing it go under $100, and just knowing that it was going to come back up to its previous levels. There wasn't a shred of doubt in my mind that Disney would recover, and it bounced back even faster than I anticipated, largely due to the success of the streaming service known as Disney Plus. Almost through the whole list here, we have Carnival stock, or ticker symbol CCL. It has been an absolutely wild ride for Carnival stock. I think I bought it from about $40 to $12, and I've made 4 videos dedicated solely to Carnival stock. Thankfully, my average cost on this stock was $18, so my position is actually positive on what was once the biggest position in my portfolio. Its dividend is completely cut now and the upside is not looking too good, but I'm glad that the stock is at least a positive in my account now. There were times when this stock was as low as $8 and my account looked absolutely awful. Thank you for all my subscribers that stuck out all those low times and are still here today. Last but not least, we have the biggest winner in my account, Apple stock, which is up a staggering 85% since I bought it back in March. Now, did I know that March was going to be the absolute low point for Apple stock and it was going to rally about 85%? Of course not, but it just shows the importance of consistently investing and then buying at different points in the year. It also shows the importance of not being afraid to buy a stock when it is absolutely plunging. Of course, you have to look at why. If it's plunging because the business model is bad, then you should probably stay away from that stock. But in Apple's case, it was just being dragged down by all the negative news. I'll also mention that the total returns of my simulated account is actually higher than the 30% that is shown. That's because dividends are not taken into account when making a simulated portfolio in Yahoo Finance. A lot of the stocks I hold in this portfolio have a sizable dividend, such as Apple stock, VOO, Disney, or even Enbridge. But that is just simply not reflected in the portfolio. I have yet to find a stock market simulator that keeps track of dividends for free. If you know of one, leave it in the comments below. That's it for my 1-year portfolio. Thanks a lot for watching, and if you haven't already subscribed, what are you waiting for? It only takes about a few seconds and means more to me than my entire portfolio. As always, thanks a lot for watching. Leave a like if this video helped you at all, and see you in the next video.